Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the jobs data and how the latest report is going to affect mortgage rates. First, here's a word from our sponsor.
Hi, I'm Sarah Wheeler, Editor-in-Chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about Safe Check. Desmond, how does Safe Check work?
Hey, Sarah, how are you? So I would say first, Safe Check is allowing LOs to give their borrowers peace of mind. So I'd start there. Trigger leads have become a very large issue, not just in the mortgage space, but in any time someone's getting any type of credit. So we created Safe Check to help prevent kind of that aggravation and nuance of receiving, tens, 20s, hundreds of calls that consumers receive. So what happens with Safe Check is any LO who uses UWM, it's an exclusive product, Safe Check is to UWM, they would be able to either pull a single or tri-merge soft pull credit report. And while that credit report is being used to run AUS, they will have time to opt their consumer out of any solicitations, and then therefore they will not receive all of those annoying calls and annoying solicitations. And that is also a big benefit because the cost of the credit bureau is much cheaper by leveraging Safe Check. So it really is a win for LOs, and it's obviously a win for consumers so they don't receive so many phone calls offering all different types of products and services.
I can see how that could be a game changer. Thanks, Desmond. And listeners, you can find out more at uwm.com.
Logan, welcome back to the podcast.
Sarah, what were you trying to boss me around earlier?
I was simply saying, please don't go in and out with the microphone. That's all I was saying. Just a little bit of
Sarah, you want to take my charts away. You're now telling me to stand still. You're, again, the best version of Logan is unleashed Logan. It's not standing still, take my charts away. How is this possible? How, out of all the people on planet Earth, you want to take the two things away from me? So this is not a good trend.
No. I'm just in service of our listeners. That's all I'm doing. Okay, let's get to it.
All right.
Yes, in service of our listeners, I know you unleashed is good. If I could mic you and have you walking around pacing, I would do it.
This is why the live events are really fun.
It's true. And we're going to have a live podcast. We're going to do it live in front of an audience and then invite the audience onto the stage at HousingWire Annual.
Yes, and I get to finally destroy the mortgage rate lockdown on record.
Okay, so all you listeners, come to HousingWire Annual, come to that thing. You get to be part of that discussion and see me take on Logan Mohtashami about the mortgage rate lockdown. So we will settle that once and for all. Big day today. We're recording this on Friday. What are the numbers?
Okay, really big week. And, we talked about this last Friday. So it's a little bit about after 7:00 here, West Coast time. So we just got the jobs report. And one of the things we talked about last week was that if there was ever going to be a week where the bond market could go crazy, it's right about here, right? We have 4 labor datas, and we're kind of at that top end range of the 10-year yield. So go back. There's 2 key levels this year: the 3.37 on the bottom end, kind of the 4.05% on the top end. And to break through the channels, these things have to break above or below. So the 10-year yield as of this morning got as high as 4.20%. Now it's fallen 10 basis points from that level, as we talk about. So I don't know where it's going to close at the end of the day, but as we are talking about, the channel so far has held again, right? And that's to me, that's important short term. You're going to get some relief with mortgage rates today, but one of the things key with the labor report today is that even though I joke with you, Sarah, that I think of Tom Petty, I won't back down, the gates of hell. Yes, the labor market is still holding up, but it's slowing right on schedule. And I think to explain this, what my people will understand why I was really bullish on labor is still going to keep on trucking, because if you take away the COVID-19 event, today we should be between 157 to 159 million jobs. Taking the February 2020 trend, with population growth and everything in that manner, we're getting into that level soon. So that means we should be starting to seeing the slowing of jobs without making too much out of that, because the job growth numbers were crazy last year. We don't create that many jobs. It's makeup demand, right? Um, so the job growth coming down is good. The wage growth data is for people. Their wage growth is very steady on a year-over-year basis. The Fed probably doesn't like to see that. We'll probably get some relief next month on some technical issues on wage growth, but the labor market is slowing, not breaking yet. So there's a big difference. The 10-year yield mortgage rates are getting to that upper end channel because the labor data has still been solid this year. So let's go over the weeks. Job openings still over 9 million. Jobless claims still under 300,000. The ADP report, let's just throw that in the trash because there's a big divergence between that and the BLS number. But the jobs number today, the internals are very interesting, Sarah.
Tell me about the internals.
So number one, 5 of the sectors were negative. Manufacturing, transportation, information. We had one really big leisure sector. That's most of the jobs gained. Revisions were negative. Hours worked was less. That means people are holding on to workers by cutting some of them. These are, things that you don't usually see in a booming portion of the labor market. So the labor market is slowing on the internals. If you wanted to understand why the 10-year yield might have fallen, we're testing a very key level. So oversold bond market condition. If you look at the internals, if you're a bond trader, you might want to go on the other side. But again, it's Friday early morning. We don't know how this is going to close, but labor's slowing down, right? It's not as tight as it used to be, but it's not breaking. Breaking is different. Breaking means jobless claims are over 323,000 and we're losing jobs every single month. So there's a key difference between slowing down, and people think slowing down means that a recession is right around the corner. That's not true. We saw that a lot of times in the previous expansion where job growth is slowing down and people just went straight for the big recession. No. So I think there's a key difference that we're slowing down right when we should be, and we need to be a little bit more mindful of some of the sectors that are holding back hours rather than cutting their labor.
So when you talk about channels, you at the beginning of the year set out a range, or maybe it was even before the year, but in your 2023 forecast, you're like, here's what I see for bond yields, the 10-year yield, and here's what that means for mortgage rates. And that's what you're talking about when you're saying we're hitting, we're testing key levels. Can you run us through that real quick, what you were talking about?
So this actually goes back to October 27th of last year. The 10-year yield had shot up to about 4.25. I think intraday it was about 4.34%. Because the dollar was getting super strong and there was market stress, you can get times in the market where the bond yields sell off aggressively. It's a little bit disorderly. When that usually happens short term, that usually means that's the top, just on a short-term basis. So then the case was, the case for lower mortgage rates, lower bond yields, made that case October 27th. So what happened after that? The 10-year yield it tried to cross over 4.25. It didn't right after that article. And then we saw the downdraft in bond yields. But for the 2023 forecast, right? And this has always been really critical to my work after 2015. I do bond market channels based on economic cycles. I'm an economic cycle person first, housing second. Okay, so that's how I move my work. So looking at the 2023 forecast, I said, okay, we were at 3.70% at the start of the year. I said 4.25 on the top, 3.21 on the bottom. All right. But the 10-year yield won't break underneath that level until labor breaks. Now everyone kind of said, okay, we're going into a recession. Even with me, with my 6 recession red flags up, I said 2 things that could help the U.S. economy. The growth rate of inflation falling, that's happened. 10-year yield, mortgage rates stop going up, that happened. Housing is stabilized. But the labor market isn't going to break. So I understand everybody went inflation first. And, we're going to have lower mortgage rates for that. That's why the Gandalf line was created. So for people who don't know, the Gandalf line was Gandalf from Lord of the Rings, you shall not pass. That 3.37 level is really critical. So every single time we got there, I had to bring Gandalf off. You shall not pass. You shall. The one time we broke underneath there was the height of the banking crisis, right? Because people go banking crisis, recession. We were there for one day, and bond yields have been going up after that, right? We've been just going back and forth. Here we're on the upper end, right? 4.25%, right? Today's top was 4.20%. There's no Gandalf line here. I'm not bringing Gandalf to this. If we close above 4.25% and we go higher, we'll have a whole new discussion, new articles, everything on that. But until that happens, I just stick to that channel. And what's going on? The labor market is not breaking. It's slowing, right? Jobless claims aren't as low as it used to be. Job openings aren't as high as it used to be. Job growth data is slowing, but it's not breaking. As long as it's not breaking, that channel should stick, because core inflation is not, at 2%. Bond markets around the world are not, negative yields like it used to be. So that's how I operate. So this week I said, this is going to be critical, right? If there was a crazy week, it's here because we're at these key levels, and you have to think like how a computer thinks or a bond trader thinks. And they're just at these levels. If things don't break, they quickly go to the other side. So as of this morning, I'll even take a last look. We're at 4.09. So that's a noticeable move. Okay. But if you look at it through channels and how bond traders work, it makes sense in that regard. And we just stay in there. Now, the case for higher mortgage rates, right? Labor market gets tighter, the economy starts growing, we start pushing wage growth up, those things would make sense. The Japanese 10-year yield, expanding that, all global bond yields shift money in some direction. These things, Japan's was a second surprise for 2023. That's the best case you can make for bond yields to go higher and stay there longer. But as of right now, we kind of, as crazy as 2023 is, it looks about right.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
So the labor breaking is really key to everything for you, because in your mind, that is what is that's what the Fed is looking at now. And you've said it before, they want to see a job loss recession, or they want to see jobs lost before they believe that we're at the right level of inflation. So you've said that 323,000 with the job market numbers today. What do you think the Fed thinks?
It's interesting because the Fed is starting to get into we're kind of at the end of our rate hike stages. But you're going to have bad cop Feds, Waller and Logan, and good cop Feds, I would say Bostic is in that group. So when we talk about what does the Fed think? Well, if the Fed is talking about 1970s inflation, they're worried about if they cut rates again, then we'll accelerate inflation higher. I've always argued that rent inflation can't do that anymore. So I don't think they're the happiest with this jobs report just because wage growth is staying firm, but they have to be happy with the fact that the growth, it's an interesting concept. The Fed would be happy with labor market slowing, but if labor market slows and they believe in their demographic theory, then wage growth would still be solid. So wage growth should slow down next month due to a technical issue. That's what they want. They want people to make less money, right? So they spend less. It's crazy, but that's their mindset. But another positive thing that happened this week that's probably not getting enough attention, productivity numbers were good, right? So if productivity numbers get better, right, that's a disinflationary factor. That's a positive. So what we want to see is productivity growth pick up. and then wage growth slow down, and the Fed will start having better languages and might not even start talking about more of a soft landing. But a soft landing to them is a higher unemployment rate, but not above 4.5%. Even Kashkari came out last week and says we believe the unemployment rate will get to 4%. So they're still in their job kind of loss or labor market slowing down area, because they know that aggressive rate hikes in a very short amount of time, there's sectors that get hit. We know this in housing, right? Housing jobs have been lost. Wages and incomes have been lost in housing, right? There's no ifs, ands, or buts around it. The existing home sales market sales are so low that incomes are down and jobs are down. So, but they would like to see that in a bigger fashion, so wage growth comes down and spending becomes less.
When you talked about the internals of the jobs numbers and you talked about, different sectors, what sector are they looking at more than others that might, have more weight?
Well, the manufacturing sector lost jobs. The information and transporting warehouse, those things have lost jobs. We know what's going on in there, but the leisure sector, services, right? Wage growth is really, this is the dirty secret. Wage growth is rising on the bottom, and they might not like that, right? Because if the bottom portion of the wage group is getting more wages and spending more, that's inflationary to them. They might not say it publicly, but that to them is they're a little bit mindful of the wage growth coming from the bottom end. So when we look at what's going on with the economy, the labor market is still firm, consumption is still firm, investment in manufacturing, of course, the government, there's a lot of deficit spending going into that. So they just want things to slow down even more, right? So if wage growth was running at 3% or 3.4%, we'd be having a different conversation, because we're starting to get back to where we were pre-COVID. 4.4% to me, they're probably there's no wage spiral out of control, but they just want to see that slow down, because they believe, even though they might not say it, wages spending creates inflation, and they're targeting core service inflation x housing, right? So the rent inflation they've already understand and kicked that out. That's what they're focusing more now. So again, for me, I would have been done 3 rate hikes ago and just say, hey, we're just going to sit and endure and see where it goes, and let the lag process kick in. But it'll be really interesting what they say now, because the next is the CPI report coming up. And remember, energy prices are rising again. So the headline data's the big collapse we saw in headline inflation from 9 to 3%. That hasn't really done anything to the bond market or mortgage rates, but the core inflation will start to come down just because of the rent factor. So how are they going to, they're not technically supposed to care about energy prices, because that's not what they do. That's the headline inflation. But the offset of headline inflation versus core inflation, these things are going to get really exciting over the next year if you're a geeky, nerdy Fed person like me. And what are the internal batters if the job growth starts to slow down more and more and more?
One of the most often asked questions of you and of me, if I'm talking to people who are like, what does Logan think about this? Or what do your experts say about this? Is like, will mortgage rates go lower or higher this fall? Or are they going to stay, where those go? And I know you have a range and we're within that range. The question is, what things could make mortgage rates go lower?
So right now we're testing a level. Okay. So we bounced off of the higher end level. If jobless claims start to get weaker, if labor data starts to get weaker, if the bond market sniffs out a recession or a weakening economy, they have shown us, right? They'll go low. I mean, we had the Gandalf line tested 8 times. That's a lot. I mean, usually we have like 3 tests and that's about it. So the bond market will allow bond yields and mortgage rates to go lower if they feel like the economy is getting weaker. But it's, I'm not a big fan of the Atlanta GDP, especially early on, because it's pretty wild early on into the quarter, and then it gets better toward the end. But it had like 3.9% economic growth, right? Jobless claims are still under 300. Job openings are under 9. These numbers are so historically good that the bond market is like, this is not recessionary. But if the labor market softens up, there's your best case. And this is why I say that, if you're running on inflation data by itself, you wouldn't be, above 7% mortgage rates, right? But last year at this time, bond yields, or some of the hottest inflation data we had, bond yields were lower. On the year, we had 8 to 9% inflation data, and the 10-year yield was much lower, and mortgage rates were lower back then. So it's not 100% on inflation right here. Well, maybe we could talk about more about that in 2024 and 2025. But as of right now, labor data, and technical ranges. Okay, that's how I've operated since I started to do this. So if you want to make a case for lower mortgage rates in the fall, that channel is bouncing off, and the labor market gets softer. That to me is your best case. So you follow jobless claims every single week. That's our weekly data line out there. And then we have the jobs reports once a month, and that'll give you JOLTS, ADP, the BLS jobs number, and a jobless claims print. So like we talked about last Friday, this was going to be a week, right? We're at the upper end range. So you hold your ground or you break, so this is why it's pretty wild. And we always talk about it gets wild at key technical levels. Like the Gandalf line was just going back and forth. And then now we're here. So we have a really wild area right about now. And I think those of you who have followed the bond market last week, when this podcast comes out, could understand. It was pretty intense week last week.
Okay, let's talk about purchase apps this week.
Yeah, one thing that I not need to clarify and emphasize right now, purchase application data is like historically low, and a lot of people, because mortgage rates had gone up recently, people said, okay, well, here we are again. Here comes the crash like we did last year at this time when rates. Okay, purchase application data is low. It's not really moving anywhere in a big fashion. So I have to explain this so people can understand. Last year was a historic event. We had a waterfall crash in housing that wasn't related to COVID-19. COVID-19, we had a waterfall crash, but that was behavior. This was a massive housing inflation hit, and purchase application had a waterfall dive. It's not doing that anymore. So the low level, this is where the inexperience comes from, people on social media and YouTube. The low level of purchase application data is not collapsing. It's just stuck. It's not going anywhere. But the front-loaded data in this data line is the second week of January to the first week of May. After May, total volumes always fall. We're doing this again because for 11 years, people keep on looking at that, and they don't understand that total volumes will usually always fall after May. Now, the last 3 years have been very abnormal in a sense. We've had 3 different episodes where we saw volumes increase, toward the end of the year. That's not normal. Okay. The COVID-19 recovery in 2020, abnormal event. 2021 was extremely abnormal. We had a big volume rise toward the end of the year. That does not happen ever. And then last year, as mortgage rates were falling, we had a pickup toward the end of the year. So we'll be mindful of that. But I think some people, they're doing the same thing I see every single year. It's the same thing with inventory. They say, oh, inventory is spiking in the spring and summer. Really, McFly? Come on. It does that every year, right? Seasonal prices getting weak. Really, McFly? It does that every year. Come on. Housing is very seasonal, right? Front-loaded up data. Even the days on market get slower toward the second half of the year. So all of us have to realize we do not live in a period where you dispatch horses to get information, right? And it's 6 months later, somebody gives you a parchment paper and, handwriting with a leaf or a feather, whatever. You have the internet, you have the ability to read. Housing is very seasonal. Don't confuse the seasonality of data, right? Just like if inventory is falling, it's the seasonal decline in inventory. It's not because demand is booming or anything like that. We have to understand all of us have the ability to read, and all of us have the ability to visually see. This is why I bring the second grade education thing out. Okay. Understand the seasonality of housing data so you don't get confused. Okay. Because the fanatics of our country, right? They do this all the time. Disinformation campaigns The reason I'm here, Sarah, is to eviscerate as many of these people as long as I'm alive, right? Whether they be extreme left-wing or right-wing people. We've seen this post-2008 social media world of disinformation campaigns borderline on Russian trolling. This is why I am still here with HousingWire today, because I'm going to do this till the very last day I'm alive. Cycles come and go, but these people, the unforgiven, right? They will go to their graves like this because they chose the wrong country to do this to. So all day, 24/7, we're ready to play ball. In any case, just remember, I saw that so much this last week, people not understanding the seasonality of data, right? Whether it be prices, days on market, purchase application data, stuff. So let's get some context back into this in all fronts: inventory, seasonal pricing, purchase apps, days on market, so we have a better understanding, because it happens every year.
It does. This is why we have you on. We appreciate you so much for your insights and looking at the data and guiding us in the right way. So, Logan, thank you so much for being on.
Pleasure is all mine, Sarah, and the end of the mortgage rate lockdown will come on October.
Join us at HousingWire Annual October 10th through 12th. And Logan is one of our headliners, giving us the economic update at the beginning of the conference. And then he and I are going to close out the conference with this really fun live podcast, which you can actually be a part of as part of the audience. We're going to call
everyone start praying for Sarah. Okay.
So I don't need prayers. I'll be fine. I don't need your pity, Logan. I am going to come out swinging.
There's no pity. It's just, the end is coming, and enjoy the last few months.
Okay. Well, we'll see how that works. Anyway, thank you again.